We're very happy at Secure Retirement to be able to have a special guest, Brian Meckley from Campbell and Company. Campbell is, to our thinking, one of, if not the best managed futures companies that exist. And they have been for a very long time. Brian, we've told clients that managed futures do well with volatility. Does it look like 2023 is likely to be a volatile year, and how might that play out?
Sure, that's the big question, isn't it? And first, let me say thank you, Richard, for having me on the call today. We really appreciate the opportunity to speak with you. But you hit the big question right out of the gate here as it relates to market volatility. And from Campbell's perspective, we'll be the first to say that market behavior can be very difficult and challenging to predict. And, frankly, especially so with so much uncertainty that's going on right now around both inflation and the central bank policies that are being designed to combat inflation. And so what that's left us with is kind of this, what we might describe as a limbo period, where the markets and market participants are going from one data point to the next data point, waiting to see how the Federal Reserve and other global central banks are going to respond to the inflationary data and the economic data to tell us whether or not they're getting inflation under control and whether or not we're going to be facing some kind of a recession. And so with that data dependency comes a high degree of uncertainty and the potential for both positive or negative surprises. And so when we think about what this could look like from a market or a volatility standpoint, we have to think about the fact that even if we had a really good crystal ball right now, and we knew what the data was going to look like for the next 3, 4, 5 months, that doesn't necessarily tell us how, one, the central bankers are going to respond to that data, and then two, how the markets are going to respond to what the central bankers decide to do. And so when you think about, how this could play out, you go back to an example of last year in 2022 in the first quarter. Federal Chairman Jerome Powell was saying that the Federal Reserve was not even talking about the possibility of interest rate hikes of 0.75%. And yet in the following meetings, they raised by 75 basis points 4 consecutive times. And so that's not to say that the Federal Reserve is without credibility, but it is to say that they can change their tune pretty quickly. And I think it's incumbent on investors to be mindful of that. While it does look like inflation perhaps has peaked, there remains the potential for what you might call a negative surprise that, in the next set of data that we get may suggest that perhaps inflation isn't yet under wraps. And so again, it's important to understand that predicting these things is very challenging. And from Campbell's standpoint, the way that we look to manage that is to build a strategy that can be very adaptive and responsive to these market changes. It does not mean that we bat 1,000, but it does give our portfolio, we think, quite a bit of agility in terms of being able to, reform itself and adapt to some of these either positive or negative surprises. The other point I want to make on that is that when we talk about volatility, we often talk about as it relates to the equity markets, right? And we use a barometer known as the VIX index. As the VIX goes higher, that means volatility in stocks is going up. And when the VIX goes down, that means volatility is lowering. But we also acknowledge that, at least in Campbell's portfolio, we invest in a lot of other markets. It's not just US equities. And so even if we see volatility low in US equity markets, that's not to say volatility can't spring up in other parts of the world, whether it's European equities or Asian equities or commodity markets or currency markets or the fixed income markets. Volatility can spring up in a lot of different places. It doesn't just have to be in the equity markets. And as Richard pointed out, our strategy is one that tends to like volatility because it creates trading opportunities for our fund. Now, with that said, if you look at a year like 2022, our fund was able to deliver some nice positive returns in a very challenging year for both equities and bonds. And a large reason for that was because volatility was more elevated. But it's also important to note that even in a year like 2021, which I know at this point feels like a long time ago, volatility during that period, at least for equities, was rather calm. It was in fact a great year for the S&P 500. And our strategy was also able to produce a nice positive return in that environment, even though volatility wasn't off the charts in the way that it was in 2022.
Got it. Thank you. Yes. So we've told clients, most people who study managed futures know you can go long or short, as you were just mentioning, asset classes around the world. Where is Campbell today seeing the best opportunities?
Sure. So a quick rundown of the portfolio's current positioning looks like this. We are short global bond markets, which is to say that we are currently positioned for rising bond yields globally. That's not just in the US, but that's also in Europe and in Asian markets. We are also long global stocks. So we are betting on higher equity prices here in the near term. Again, that's across all of those geographies across the world. We are currently net long the US dollar, although within that comes a lot of different positioning. We might be long the dollar versus, say, the Japanese yen, but we might be short the dollar versus a currency like the euro, for example. So the dollar exposure is something that we have been very actively trading on a long and short basis. At this moment, we have a net long exposure there. Of course, as you mentioned, Richard, all of that could change by tomorrow. And then finally, within commodities, we trade energies, we trade metals, and we trade agricultural markets. And so there's a lot of different things that make up our commodity exposure. On the whole, we have a net short position there. Within that, most of that exposure on the short side is in the energies and the industrial metals markets. We do have a nice long positioning in some of the grains markets. So as you can see, there's a bit of diversity across that commodity exposure. And like currencies, that's an area of the portfolio that we've been very actively trading over the last few months on a long and short basis. And that's so essentially, in short, that is how the portfolio breaks down. But the caveat is always that is how we are positioned at the moment. But again, the portfolio is capable of repositioning fairly quickly. So I would encourage you not to extrapolate too long a forecast from that, as that again is our current positioning subject to change.
And how do those allocation changes happen? What leads to them?
Sure. So that's an important part of our process at Campbell. We employ what you might call a systematic investment strategy, which is to say that we use a combination of computer models and, of course, live human beings who build those models to essentially sift through oceans of market data and in an attempt to identify these trading opportunities. And so it's a quantitative investment process that is looking for these opportunities, whether, again, they emerge in commodity markets or currency markets or equities or bonds. Essentially, we are looking for some type of directional moves in these markets. And again, we use computer models to help us identify those trading opportunities.
Now, one question I had involves macro forces. I know in a pure managed futures fund, like an index of managed futures, I don't think they're agnostic about macro features. They're just following trends, no thought behind, the factors involved that might lead them up or down. You use some macro. How does that work?
Sure. So you've alluded to, one of the distinguishing features of Campbell's program is that we employ what we refer to as a multi-style or a multi-strategy approach. And you can perhaps contrast that with some of the other funds in the managed futures category, which for the most part tend to employ a trend following style of investing. Now, make no mistake, Campbell, we've been doing this for 51 years, and over our entire history, we have been big fans and advocates for trend following strategies. And certainly that is an important ingredient in our fund as it is constituted today. But one of the things that we do a little bit differently at Campbell is that we integrate, along with our trend following strategies, some other systematic investment styles, one of which we call quantitative macro, and the other we call short-term trading strategies. And without getting too much into the details, unless you would really want to explore that, the idea here is to create a really, in our view, an all-weather type of return profile. We don't want to have to anticipate when inflation is going to be a problem. We don't want to have to, anticipate when the Fed is going to raise or lower interest rates. We want this strategy, again, to be as adaptive to market changes as is possible. Trend following is a really good way to do that over a full market cycle, but we have found that by employing this multi-style or multi-strategy approach, we can create a smoother experience for our investors. One that potentially delivers, strong returns, but with less, we hope, turbulence along the way. Certainly, past performance is never any indication of future results, but we're encouraged again by what we've seen over the last few years in terms of this strategy's ability to, respond to the emergence of inflation and then the onset of rising interest rates.
Very good. And then my last question is one that I know Campbell has been talking about lately because it's a great thing. We're hearing that the cash feature in managed futures is turning out to be a good thing this year. Now, I believe most managed futures funds have approximately 85% in cash. What's this doing to your fund these days? The fact of cash having interest these days, now.
Sure. So managed futures is what we refer to as a capital efficient strategy, which means that in order for us to fund our strategy, we do not need to take every dollar that's invested in the fund and deploy it to the markets that we trade. So when you think about the name managed futures, how we arrive at that terminology, it's because the way that we access the underlying markets that we've been talking about, like commodities and currencies and equities and fixed income, is through the use of futures contracts. Now, those futures contracts are derivative instruments, which means that they are capital efficient, which once again means that we don't have to deploy every dollar in the fund to create that market exposure that we want. So a large percentage of the fund's assets sits in a cash managed account, which is invested in 90-day treasury bills. The benefit of interest rates being more elevated today than they were, say, 2 or 3 years ago is that those treasury bills are now kicking off interest income. That interest income is now an alternative source of return, or an additional source of return, I should say, for the fund. So not only are investors in the fund benefiting from our trading activity in all of those futures markets that we've been talking about, but they're also getting that nice interest income hitting the bottom line as well. And in fact, the interest income that's coming off of those T-bills is actually higher than the current expenses of the fund. And so that's a really nice tailwind for investors who are, looking to create some more diversified exposure in their own portfolio by utilizing a strategy like managed futures that can potentially perform whether stocks and bonds go up or down, but at the same time also harness a little bit of an extra return off of that interest income thanks to the higher interest rate climate. Now, it's important to acknowledge also that that benefit can improve if interest rates were to go higher from here, but it can also diminish if interest rates were to move lower from here. So it's not a static benefit. It can fluctuate based on whether or not interest rates go higher or lower or stay the same. But for now, that interest rates are elevated, it's kind of the icing on the cake, if you will.
When markets have radical short-term changes in their direction, which occurred in mid-October, it's like almost everything flipped about 180 degrees. Everything that had been going down started to go up and vice versa. That is typically a difficult time for managed futures, and it was hard for Campbell and all the funds. And then the market continued to be in that new direction, up for risk assets, and yet you started to make money. Your fund did. How'd you do that?
Well, I'm really glad you asked. But one of the main reasons I'm glad you asked is I do think it's important to highlight when a strategy like ours, for all of its potential benefits, it's important to understand that no strategy is going to make you money all the time. And so it's important to appreciate, okay, well, what's an environment that may be more challenging for the strategy? And I think you summed it up very nicely, which is our strategy tends to struggle during moments where there are sort of, sudden reversals in some of the trends or some of the themes that we've been trading on. And certainly that was the case in the third quarter. So if you think about last year, the performance of managed futures funds was largely driven by three themes. It was the rise in commodity prices in the first half of the year. It was from the rise in bond yields that occurred for the duration of the year. And it was from the strength of the US dollar that occurred for about 3/4 of the year. And so what tends to happen, we have an expression in the managed futures world where we say that the trend is your friend. But we also say the trend is your friend until the end when it bends. And so we generally like when markets are moving directionally, and that was the case for much of last year. But in the end of the third, into the fourth quarter last year, there were some trend reversals. We did see a couple of the trends bend. We saw the US dollar trend reverse and the dollar started to weaken. And then we saw, of course, commodity prices reversed in the middle of the year and started to decline after their peak in late June. And so our strategy, while we did take some losses in the near term as those trends were reversing, if you go back to our discussion about some of those non-trend following strategies, some of the things that we think distinguishes Campbell's approach here, one of those is an allocation to our short-term strategies, which, as the name implies, are meant to be much more tactical in their trading and did a really nice job of helping us to get out of some of those losing trades that were working against us. And so the idea for our multi-style approach, if you will, is to play really good offense when the trends are running in our favor, but it's also to play really strong defense because we know those trends can't run forever. And eventually when they come to an end, we want to make sure that we're not giving back too much of our profitability, and we want to play that strong defense, and the short-term strategies really help us to do a nice job. And so that's what we saw in the fourth quarter, where we got out of that long dollar trade. We actually got net short dollar. And lo and behold, Richard, to your point, that is one of the reasons why we got off to a good start here in 2023, was thanks to our ability to respond to those market changes. And I think that's an important point for me to kind of wrap up this thought with, is that, a lot of folks came to us at the end of last year and said, hey, it's wonderful, Campbell, you did such a great job of helping us diversify this risk of inflation and rising interest rates. But what happens if inflation goes away, or what happens when interest rates come back down? Does that mean your strategy isn't going to work quite as well going forward? And again, past performance is no indication of future results. But remember also, the strategy is meant to be all weather. And so if, for example, we saw inflation come down, if we got disinflation or even deflation, or we saw falling interest rates, well, guess what? Those are trends too. And the strategy is built to be, as you mentioned earlier, Richard, kind of agnostic or indifferent to which direction these markets go, provided they go somewhere. We should have the potential, of course, no guarantee, but the potential to perform in a multitude of environments.
We're talking about managed futures, and we've spoken a lot about this topic over the last few years, but it's still kind of complicated to some people. So could you just tell us, Brian, what are managed futures? How does this work?
Sure, that's probably the toughest question of all to answer, Richard, because there's a few different layers of explanation depending on how detailed you want to get. So I'll start at the very short version, if you will, and we can sort of tease it out from there if you'd like. But essentially, managed futures is an investment strategy that's designed to produce returns that help to diversify a portfolio of stocks and bonds, which is to say, this is an investment strategy that has the potential to generate returns regardless of whether stock prices are going higher or bond prices are going higher. And in our view, can help to serve as kind of the third leg to the stool in investor portfolios who own, those who own stocks and who own bonds. This adds, in our view, some stability, what you might call the shock absorber for a portfolio.
What is the highest allocation you could have, long or short, US stocks? Is there a rule?
So our portfolio, our fund, allocates to over 100 markets globally. And so our mandate is to have some exposure, whether it's a long position or a short position, in all of those markets at any point in time. And so by its own design, we are not going to have too large of a percentage in any given market or asset class. Now, your question is, well, what's too large of an allocation? And so what I can tell you is that historically, the fund has averaged about a 25% weighting to each of the 4 asset classes that we trade: stocks, bonds, commodities, currencies. Now, at any point in time, if you check out the portfolio and how it's currently positioned, we might be overweight a certain area like commodities or underweight another area like bonds, for example. But over time, that's generally how things break down. But also understand that within that, 25% average weighting to something like equities, that includes not just the S&P 500, not just US stocks, but it includes stock indexes all over the world, right? And so it's, again, not just US centric. And also, even if we have a significant exposure to the equity asset class, it may not be a long position. We may have a long position in the S&P 500, and we may have a short position in the NASDAQ, or we might be long European stocks and short stocks elsewhere in the world. And so while we maintain, again, a very healthy level of diversification by design, it's also important to acknowledge that those percentages or those weightings take on a different dimension when you think about the fact that we can be either long or short.
Yep. Very good. Excellent. So your diversification is always there, and you're never going to be led around by the nose by any asset class.
That's right. And to add to that, we have a very rigorous risk management framework that's employed on the fund, which is designed to acknowledge when correlations amongst assets change, which is to say that, we tend to think as investors of risk being siloed based on the instrument or the market that we're trading, right? Stocks behave one way, bonds behave one way, commodities behave another way. Historically, over a very long period of time, the relationship between stocks and bonds and commodities tends to be very complementary, meaning they don't often move together, whether higher or lower. But that, again, is over a very long period of time. Over a shorter period of time, there can be aberrations where they do, in fact, move together either higher or lower. It's what we call a higher or lower correlation. And so we want to be very careful in our portfolio. Even though we're trading a lot of different markets, there can be moments where, even though we're trading stocks and bonds, the risk may be elevated if they are suddenly correlated with each other, such as was the case last year. And this, of course, was a big challenge for individual investors who, for many years, enjoyed the fact that equities and bonds had this very complementary low correlation with each other. And then all of a sudden, boom, last year they got very positively correlated. And unfortunately, both suffered losses together for much of the year. And so in our portfolio, again, we have to be very mindful of that as well, to make sure that we maintain a proper level of diversification there as well.
Excellent. Brian, thank you very much.
Thanks so much, Richard. Really appreciate it.